Our next two guests continue to be positive on the markets going forward. We bring them in right now for their thoughts on Bernanke and what to expect. They're joining me from the Schwab Impact Conference in San Francisco. Neil Hennessy is portfolio manager of the 4-star rated Hennessy Focus 30 Fund. Tim Lydon is president of Global Trends Investments and editor of ETF Trends.com. It is nice to have you both on the program. So, Neil, let me kick this off with you. All of a sudden, 2 days after a 600-point sell-off, now we're back to bull mode here because of what the Fed said and this anticipation of strong earnings. Is it justified?
First of all, the volatility up until August 4th of this year, we never had a day that was over 300 points either way, up or down.
Right. Since
August 4th, there's had 11 days. I think what people are missing or maybe coming back to look at, no matter if you look at PE ratios, book to ratios, or cash flow ratios, or price to sales ratios, the market's cheap on a historical 5-year or 10-year basis, especially on a cash flow basis.
But that doesn't mean it doesn't get cheaper, right? I mean, let's not forget, Tom, Bernanke said, here's a couple of headlines from the Bernanke conference. You cannot ignore the Europe woes. Europe woes have been a drag on recovery. Advising Americans to be smart about personal finances. The Federal Reserve is prepared to do more, has the tools to do so. What are those tools?
Well, it's all about confidence, Maria. And what he's saying is the average investor doesn't have confidence. You get thousands of advisors right here who have calluses in their hands from all the hand-holding they've been doing the past year.
Yeah, really.
All right? Investors need confidence in order to put money back in the market, in order to buy, and corporations to put money back to work and hire. That's the key situation here. And if he can say things like this, like we have tools, it'll help boost confidence. So maybe as we get into the end of the year, we're going to see higher markets.
Look, obviously the Europe story is not going away overnight. How do you want to invest given these headwinds and these mixed signals we get?
I think you got to separate out the economy, separate out Europe, separate out Washington politics, and separate out corporate profits and what corporations are doing. Even during 07, 08, 09, 2010, 2011, companies are making a tremendous amount of money. They're just hoarding cash because they don't have any clarity on what their taxes are going to be, what an employee is going to cost on health care, what the rules and regulations are going to be. And under Sarbanes-Oxley, which is 2003 rules, the shareholder has to come first, and if you go higher and don't know the cost, you're not taking the shareholder first.
So what do you want to do, Tom?
Yeah, well, I think today Bernanke talked about technology. I mean, technology is booming. I mean, we're seeing great earnings in those areas. As Neil's saying, earnings are good as far as consumer discretionary. There's some great ETFs that hone in on the consumer discretionary market. As we get into the Christmas season, investors are sick of being Scrooges. They really want to spend. They want to be happy. And I think as we saw $25 billion go into ETFs last month, if we see that push and we actually break above that 1275, the high that we just saw recently, I think we could see a great Santa Claus rally and, in fact, even a market melt-up.
Which ETFs are gaining the most money here? Where do you see the real smart money moving into in the ETF universe?
Yeah, Russell 2000 actually had, if you look at all the Russell 2000 oriented ETFs, they had about $6 billion just in the last 3 weeks.
Small mid-cap.
Small mid-cap, and they also tend to be more technology oriented. So that's been very strong. And consumer discretionary as well. Gold also had some very positive numbers last month. Money went out of treasuries, obviously, as the market was flying.
Neil, what about you? Where are you placing your bets right here?
I think there's two places. Number one, low-end retail. You can do a Domino's, you can do a Family Dollar, you can do a Ross Stores. What really hit me the other day was utilities. If you look at the utilities, and when we rebalanced our Focus 30% of the portfolio is now in utilities, yielding 4.25%.
So is that a dividend play?
Because if you look at 4.25%, those stocks would have to go up 30% to get down to a 30-year bond yield. So you can see where the money's going. Companies are initiating dividends, they're raising dividends, buying back stocks. That's what they're doing. Everything's for the shareholder right now, and that's what's going to continue to drive the market, dividends.
So what did you make of Bernanke's comments about the economy? Look, let's not sugarcoat this. He took his expectations down. Is that priced into the market here?
Personally, I think so. It doesn't take a genius to figure out unemployment's not going to move lower. It's going to go higher. Tom was just talking about technology. Why are they doing well? Because companies are putting money in the internal infrastructure. That's good short term, but not long term. It means that once the economy starts up again, they don't have to hire back as many people.
You know, housing and employment is something that we're going to have to suffer with for a long period of time. But what the average corporation is doing in the U.S. is they're getting around it. They're finding ways to deal with that situation that we have going forward. And innovation is hot. If you just look around this conference here, there's a lot of innovative companies that are looking outside major asset classes, looking at alternatives, looking at commodities, looking at currencies, ways to kind of augment people's portfolios.
Explain that a little more. You look around this conference, innovation is hot. Where are you seeing innovation and growth? Because I agree with you. That's where the money is moving, where the growth and innovation is.
Well, just alternatives alone. For the average advisor investor 5 years ago, they didn't have an asset class as far as commodities or currencies. Today with ETFs, we have so many different choices that we can somewhat balance portfolios or look at opportunities to actually have some growth while regular asset classes are very stagnant.
All right, we'll leave it there. Tom Lydon and Neil Hennessy, great to talk with you.
Thanks, Maria.
Thanks so much, gentlemen. We'll see you soon.